There is an ongoing heated debate between investors and traders about what strategy is the best when it comes to investing your money. We have the investors saying time in the market is the best. And on the flip side, we have timing the market as the trader's strategy of choice. Now, we've covered this topic in a previous video, so I will link it above if you want to check that out. Why I bring this up is that today we are talking about the psychology of loss aversion and kind of a strategy that you can put into play to help avoid this from happening. Now, if this is your first time here, my name's Nick. Welcome to Ways to Wealth. I have a huge favor, a huge ask. If you learn something new or you get some value out of the video, hit that like button for me. I would definitely appreciate that. And if you haven't already, please consider hitting that subscribe button and turning that notification bell on. Would love to have you a part of the community. What we'll do now is we will cover what loss aversion is all about. So it is a cognitive bias that describes why, for individuals, the pain of losing is psychologically twice as powerful as the pleasure of gaining. So we see here in this meme, the guy gets $10. He's like, okay, cool, $10, that's all right. But on the flip side, losing $10, the pain is insurmountable. This guy is, absolutely gutted right now that he's lost $10. And how does this pertain to stocks? So we see down here, an individual is less likely to buy a stock if it's seen as risky with the potential for a loss of money, even though the reward is potentially high. So you look at something like a Tesla, for example, and obviously a lot of investors and a lot of older people think that the stock is way overvalued. But it seems like time and time again, this company is always growing and looking for the next way to be the company of the future. And that's where you've seen it hovering around that $700 mark. And then all of a sudden this week, you had the Hertz news, you had a bunch of different news, and this thing is up over $1,000, even approaching the $1,100 mark. So people are less likely to make a decision if they know the risk is high. But we've talked about it plenty of time before. High risk, high reward. You just need to have that understanding and that mindset when you were making that decision. We're going to look now at taking financial risks. So examples of loss aversion are especially notable when looking at financial decision making. Based on loss aversion, it can be assumed that an individual more heavily weigh potential costs and failures than the potential benefits and rewards, especially when it comes to managing their own money. Now, this is where, part solution right off the bat is that if you do not feel comfortable buying individual stocks, you should be buying ETFs that give you diversification, that contain many different companies within a particular sector or index like the TSX 60 or the S&P 500 that we've discussed many a time before. You just invest in something like that. You take out the individual risk of owning one company. Now, if you want to get into the mindset of owning individual companies and being a stock picker, this is where the potential comes in, that obviously you're analyzing a company. You may think that it is a little bit too risky, and all of a sudden it drops down a certain percentage and you want to cut and sell. So this is where an individual might go in and say, hey, if I like the company at $60 per share and it's gone down to 40, well, realistically, did I make the right decision? You start having all of these different negative connotations, negative thoughts that are coming to your mind, like, oh my God, like I'm the worst investor in the world. What am I doing? But then you have some other people that are, hashtag never sell. You buy something, you average down when it goes down. Sometimes the market gives you opportunities to buy great companies at better prices. This is the Charlie Munger, Warren Buffett side of things. And you got to have that psychological awareness that the market is mispricing And, this is where, being a little bit more trained, a little bit of a better skilled investor, this is where something comes into play. And just to give you a little bit more insight to these psychological effects, what we're going to do is we're going to look at an example here that the article pulled up to give you a mindset and to make it a realization. Is basically the point of this video, is that we understand that when we're down money, we put more precedence and we put more attention on it than if we were up big money. So we have here another example of loss aversion concerning financial decisions, and behavioral economics can be seen in cases of groceries and price sensitivity of individuals. So we have Dr. Putler here in 1992. He put together a study regarding eggs, the price of them, and demand change. So between July 1981 and 83, the team noted that when there was a 10% increase in the price of eggs, the demand in turn dropped 7.8% due to the price increase. So obviously something goes up, people are less likely to buy it. That makes pretty much sense in terms of the hypothesis. On the flip side, when there was a 10% decrease in the price of eggs, the rise in demand was only 3.3%. So this is kind of where the question comes into play, is like, how psychologically affected can we be if the price is to decrease? And we see this right here. You would expect that 3.3% number should be a lot higher. So this study exemplifies an individual's price sensitivity regarding their loss aversion, with individuals influenced by potential losses more than potential savings. So when I do go in and I pick something on a stock basis, I either average down when the equity position, when the stock goes down negative, or I hold on to it because I have a reason as to why I bought it. So psychologically going in, when I buy something, I have a theory or a thesis behind it. If it comes down to a point where there is a decision to cut this loose, this is where my next point is going to come into play. So when we look at this chart right here, it's called the gain required to make up for a loss. So sometimes it is better to cut that position loose because the percentage that stock needs to rise to get up to the level that it was at before to even break even is just insurmountable. So we have here a 10% decrease needs an 11% gain. That's not bad. We then continue to rise. Let's say if a stock position is down 50%, in turn, we need that stock to rise 100% from its lows for us to break even. And on the flip side, if you have something down 90%, you need that to increase 900% in order for you to even break even. So sometimes it is better to cut your losses, and you do need to have some type of game plan when it comes to buying a company. Are you going to continue averaging down? Are you going to cut that position loose at a pre-specified, percentage? So saying, hey, I'm going to buy this today at $60. If it goes down to 45, I'm going to sell it regardless. If it, happens to go down even further, what am I doing in terms of a game plan? One of the things that I've heard, and I particularly am starting to become more keen to it, it's selling your losers and riding your winners. It's almost better to buy a company that's increased from that $60 mark up to 80 and continuing to add to that position than it is to throw money on certain loser companies. So this is kind of where I'm looking at my portfolio saying, hey, is there a percentage that I need to put a stop loss onto in terms of this is the amount of risk that I'm willing to put on a certain position, whether that's 15 or 20%. And if it hits that amount, I'm going to take the remaining capital and I'm going to put it on a company that is performing well. And this is, one of the psychological understanding or even the game plan that is required when it comes to owning individual stocks. So I'd love to hear what your thoughts are on this. What are you doing in the marketplace? Are you saying, hey, I want to take the risk of owning individual companies out of it? I'm owning ETFs. These things shouldn't be down over a long period. I'm going to consistently buy at a specified time period or a specified cash value. Or if you are buying individual companies, what is your game plan? Do you have a stop loss in there? Is there a number on the downside that you're saying, hey, I'm getting out of this? Or you're going to consistently dollar cost average until you drop down, that $60 cost basis down to 40 or 45, whatever it is, and hope that over a 5-10 year, are you a part of the hashtag never sell, or are you the hashtag stop loss crew? I'd love to hear your thoughts and opinions. If you're still here with me, don't forget, hit that thumbs up button. I hope you enjoyed the video. I'll see you all next week. I hope you have a great week in the markets. Happy trading.